Hello everyone, and now we are continuing further with this chapter. Previous video was about the relationship between the various ratios. Now we talk about another set of measures where we check the liquidity of the business. How much cash do they have with them? Let's suppose if any sort of an emergency is coming up, then does the business have enough money to meet those, emergencies? Maybe a tax liability, maybe some legal penalty. So, do they have enough cash on them to be able to meet any urgent requirements? So, liquidity measures basically check for that. Even if the company is very profitable, it is possible that most of their profits are invested somewhere. So, maybe I hold a lot of shares, and in that shares, I'm holding a lot of profit. Maybe I have 10 lakhs worth of profits, but then the money is not in my hand. Let's suppose if today someone is coming up to me and telling me that you're going to get arrested, so you need to pay money for the bail. So do I have money right now? No, I may be in profits worth 10 lakh rupees, but I do not have money right now. So in any sort of an emergency, I should be holding enough cash so that I'm able to meet such urgent requirements. That's why we measure the liquidity position of a business. So the number one formula that you see is the current ratio, which is calculated as current assets divided by the current liabilities. And the next one is the asset test or the quick ratio, which is current assets minus the inventory. Rest of the formula is remaining the same, only that you have to subtract inventory from the quick ratio. So quick ratio, why are you subtracting inventory over here? Because they want to see how much of quick cash do you have right now. Inventory may take some time to get sold off, but the cash that's lying in your hand, the bank balance that you have, the receivables, that thing can be, collected right now. So that's how they want to check for the quick assets, the assets which you can quickly convert into cash. Only those assets are being considered over here. Now, talking about the interpretation, so the ideal ratio for the current ratio is supposed to be 2 is to 1. That means if I have current liabilities, if I have to pay $10,000 in the market, then I should be having $20,000 worth of current assets with me to support those liabilities. Otherwise, if I have lesser current assets with me, I may run into financial trouble. So, this is the ideal ratio for the current ratio. And for the quick ratio, it's meant to be 1 is to 1. That means my current assets, except from inventory, should virtually be equal to my current liabilities so that I'm able to repay my obligations as soon as they fall due. Now, this was the concept. Now, I'm going to take you to the question that's there on the study hub. All right. So, I hope that now you're able to see both of the screens in front of you. All right. So, here's activity 3. A company has current assets of $1 million, including inventory of 0.7 and current liabilities of 0.4. What would be the effect uh, on the value of the current and asset test ratios if the company bought more raw material inventory on 3 months credit? Now you have to indicate whether the raw material purchase on credit would increase or decrease the liquidity ratios. So first, what we are going to do is let's calculate the ratios in front of us. So the first formula is current assets, which is 1 million, divided by the current liabilities, which is 0.4. So virtually your current ratio is 2.5, which is a good symbol. It's meant to be 2 is to 1. You have 2.5 is to 1. That's good. Now coming to the quick ratio. So the formula is current assets minus inventory. So your current assets are 1 million, inventory is 0.7 million, and this needs to be divided by the current liabilities of 0.4. So this gives you 0.75 as your quick ratio. Now this is not up to the mark because it should be 1 is to 1. Now let's see how it's going to impact whether the current ratio or the asset test ratio, is it going to increase, is it going to decrease because of purchasing raw material on credit. Now always remember, as a basic thumb rule, if you follow this technique, you're never going to go wrong with any questions where you have to tell increase or decrease in a ratio. Always take an imaginary figure and try to work out the calculations and then see what impact it is having on the ratio. Now, let's assume we are buying inventory. The question is telling us we are buying inventory on credit. Let's suppose the inventory is worth $0.5 million, which we are buying. So, my current assets, which were earlier 1 million, now are going to be, because inventory forms a part of your current assets, they are going to be 1.5 million. Now, if I talk about my current liabilities are also going to get increased by the amount of the inventory because I have taken this on credit. I have not yet paid the money to my supplier. So 0.4 is my existing one and 0.5 gets added. So now my current ratio has come out to be 1.67. So my current ratio was earlier 2.5. Now it has decreased to 1.67. Similarly, you'll do it for the quick ratio also. Now, under quick ratio, you take the quick assets or you take the current assets minus inventory. So, earlier also your quick assets were 1 minus 0.7 and now you have purchased inventory. So, no addition to the quick assets. So, your quick assets remain 1 minus 0.7, which is 0.3. Now, talking about the current liabilities, we have already calculated that to be as 0.9. So, you can say this was the revised current ratio. Now, we find out the revised quick ratio. So the revised quick ratio is going to be quick assets divided by the current liabilities, which is also, you can see from 0.75, it has decreased to 0.33. So under both the scenarios, under both ratios, the purchase of raw materials on credit, purchase of inventory on credit is going to decrease these ratios for you. So this is all about the liquidity ratios that were there. In the next video, we're going to talk about the gearing measures. After that will come the resource utilization measures with which we will conclude with this particular chapter.